being made by Investec when it comes to the metal space. It's on the risk reward ratio and it's on the valuations. A big upgrade coming in on metals by Investec. In fact, JSPL, Steel Authority of India, as well as NMDC. All three are being upgraded to a buy. So let's understand the rationale behind this with Ritesh Shah, the lead analyst at Investec Capital Services. Ritesh, a pleasure having you with us. And I suppose your note is coming at a time when obviously the metal stocks especially have been whacked out of shape in the last couple of months. I think they are the biggest victims of the pandemic, the coronavirus. So let's start off first by understanding what makes you optimistic at this level on these names, JSPL, SAIL, NMDC. They are mid-cap names. These are the ones that have seen significant carnage. SAIL in particular. Is it purely valuations, that's making a case for the buy stance?
All right. Hi. Thanks for having me. First, the reason for the upgrade is predominantly valuations. There are a lot of headwinds. There is a cocktail of negative news flow. It's started from OECD. You had locally Yes Bank fallout, and number of other reasons. But looking at basics, bottom up, one has to look at what is the valuations currently impounding, be it for JSPL, SAIL, or NMDC. So if you do a sensitivity around numbers, what it essentially implies that the spreads, which is EBITDA per ton, could actually contract to the extent of 2,500 rupees per ton, say something for Tata Steel. Now, what we're disputing over here is two things. You have to look at it from a numbers point of view. One is from a price angle and second is from a volume angle. Now, can there be price degrowth going forward? The answer is definitely yes. It can be the case. However, to what extent, that is something which needs to be understood. Now, what the prices are impounding right now is the spreads will decline by around 2,000 to 2,500 rupees. What it essentially means is the Chinese steel mills, the blast furnace guys who are already making losses, they will continue to operate, making further losses into entire FY21. Now, this is a very remote, low probability event, and hence we rule out prices actually declining to this level. So that is one. Secondly, if you look at local HRC prices, they're trading at around 37,500 levels. Government had imposed MIP at $478 to $489 a while back. Now, that is something which is already in effect as well. So the prices also can't go below a certain level. You have a floor defined over there. So if one is looking at earnings from a price angle, you have protection. One is from economics actually coming to play. You can't have Chinese steel mills continue to operate losses and continue to pump volume. So that's not something which is likely to happen, right? So it's a very low probability event. Secondly, I think the question is obviously on volumes given the COVID issues locally. Can there be demand destruction for a quarter? We don't rule it out. But that is also something which is quantifiable, right? So if you take away a cash flow for a quarter for any particular cement player, you can still derive at the valuations. Now, you factor both these variables together. That is where we conclude that the risk-reward is far more favorable for these three companies, JSPL, SAIL, and NMDC, and consequently, we upgraded it to buy.
Okay. In fact, if we look at all the metal prices as well, what's happened since the outbreak of the coronavirus, iron ore prices have actually gone from 92 to 94, and steel as well. The fall's really been barely anything. It's been extremely marginal. So, Ritesh, in the absence of a major decline in steel prices, would you say that this recent correction that we've been seeing, especially in the steel companies, is actually running ahead on fundamentals?
So I think the market's reaction is more knee-jerk. What you rightly pointed is very correct. Iron ore prices have been pretty robust, trading at 90-plus levels. This is, again, on back of supply-side issues. If you just go back on the news flow over last 3 months, the diversified larger miners, they have actually cut down their supply guidance. That is something which is definitely supporting it. If you drill, the great differential between 65 to 62 has continued to widen. Again, it's a very strong sign. Coking coal prices have also been pretty flattish. So essentially, you have support on the cost side. Now, what I'm saying is, if the steel prices have to go down, what the current market prices impounding for, be it Tata Steel, JSPL, SAIL or NMDC, is something, a scenario what we don't foresee. That is the reason we say risk reward is far more favorable.
Ritesh, a pleasure chatting with you and getting in your perspective on the metals basket. Thanks once again for joining us.